Michael, please unmute and welcome back to Face.
Hey
How
Dale,
are
how
you?
are you? There's a fire alarm going off in the background here, so I don't know.
Wow.
Yeah.
Right there, what, on the beach? There's, is it in the fire pit or what, Michael?
There's a
Yeah, it's in the
barbecue in
fire pit,
front.
keeping me warm on this 27-degree morning.
All right. Well, Michael, great to have you here. I went through your stream.
Yeah,
You have anything, any charts or anything you want to share? I'll just put up some charts.
I can
Uh,
share my screen, but I don't have anything specifically. I've been actually sort of slowing down on Twitter a little bit. It's getting to be a little bit too much for me these days.
in what way?
I don't know. There's just a lot of stuff going around on the broader feeds that I find to be super annoying, and I think the comments are just a little bit overwhelming at times as well. So I just feel like, you know what, if people aren't going to be respectful of the work that I'm sharing with them for free, then I don't really need to be bothered to post there as much.
Yeah,
Um,
well, I think that everyone who's in the public sphere feels that way, Michael.
Yeah,
That
and I
that
just, more broadly, I get annoyed because, 4 weeks ago when the market was tanking, there were a lot of people who just kind of vanished from the realm, and now they're out running themselves as if they called the bottom, and it's a really difficult. I think it really shows you, I think, what a lot of people are on this platform for, which is really just creating
the,
their own, generating their own self-interest and pushing an agenda. So anyway, I've kind of backed
Michael,
off.
I actually think there's that after COVID and everything, that a lot of people have PTSD from it, and it's almost a channel for their aggression and
Right.
anger. There's a lot of anger in the country.
Yeah.
If you're not the 1%, you're not cleaning up. They're saying inflation's coming down, and wherever you go, it doesn't seem like it's going down. And
Yeah, no, I mean it's
people
not.
are being squeezed.
And
They're
it
being
and
squeezed.
that's the problem, is that it's really not coming down. And there's this, you have, like you were just talking about, oil prices, and you have energy disinflation, which is really sort of uh masking some of the underlying weakness in prices. And then you have these stupid metrics that the Bureau of Labor Statistics doesn't know how to calculate, like health insurance. I mean, these antiquated ways of going about calculating an expense that's gone down for nobody, but yet, the BLS thinks it went down 37% last year because they look at retained earnings. I mean, if you look at a chart of UNH, I can tell you that health insurance seems to be doing quite fine.
Okay, interesting. I want to start with the S&Ps because on your feed you talk
Yeah.
about easing of financial conditions, which forget this 4 hour stuff. Let's take a look at the daily. So this rally from late October was took place under easing financial conditions, right?
Yeah, exactly. And what I think people miss about this rally, I woke up this morning and I kind of woke up in a bad mood, I guess, because I saw the S&P 500 was up 40 basis points. And the reason why it annoys me, like days like today, is that if you look at Asia, it was absolutely hammered last night. And there was really no news out overnight that should have resulted in this overnight ES pump. And Germany is up now a little bit, moving up as well after the weaker than expected uh, CPI numbers. But I mean, Hong Kong is just getting obliterated every night. South Korea, even with its short selling ban, can't catch a bid. Taiwan, which is very, highly correlated to the NASDAQ 100, hasn't really been performing all that well. And when you look at the rally off of the lows in October, it was a totally mechanical rally. I don't know if you remember the last time I came on. I think the S&P 500 may have been right around these levels, and we were talking about the relationship between the S&P and
Canadian dollar.
the Canadian dollar, and how I said that I thought we
Yeah.
were going to go right back to 4,100, which is exactly, what happened. The Canadian dollar went up to 136, 137. The S&P 500 gave back all the gains. I think we're actually in the same exact position as we were then. Uh, It's just
Really?
that you would never know that we fell 10% and rally 10% in between the period. Um,
All
and
right. So
essentially,
you're saying that easier monetary conditions, which drove up the S&P, is going to be responsible for a retracement of the market because they eats too much. So are you
right.
talking about that, when we hear Powell in a few weeks, he's going to walk back
Well,
a lot
he's
of things?
talking on Friday more. He's talking on Friday actually at 11 a.m. And the thing is that my analysis shows that when financial conditions ease, it tends to hit the economy within 6 to 9 months, right? And so when they ease too much, what it tells me is that we went through a period of tightening, right? So we're likely to see some slowing in the fourth quarter. But I think what's going to happen is that you're going to get another reacceleration in the economy come March because financial conditions have been easing. And I think the tough spot for the Fed is that if financial conditions ease too much, you're going to find yourself in a situation where conditions are too accommodative, and that's going to allow inflation and the economy to really start reaccelerating again.
Do you
And
think Paul cares about gold being over 2000? Do you think Paul cares about that perhaps a dollar is broken down? And, I want to get to this because this was part of the catalyst for the rally, a huge part of the catalyst. So, let's go TLT. And I want to acknowledge that when the TLTs were up here and trying to hold, you said you were looking for one more decline, and it was based upon Prechter's work, actually.
right,
How
right,
do you
right,
like my memory? All right, so
you always remember everything.
all right, so we did. We went to 82, and this was wave five, and we've had this recent rally.
Right. And you
Do you
can see
think
the
there's
rising wedge there, right?
Yeah, I mean, if we get a pullback to 86, I would consider buying it for another wave. Do you think this is just a temporary reprieve in the bond market and we're going to make new lows, or there could be a pullback and then another advance?
Um, so right now, what I'm actually beginning to think about is that we probably have seen the area in which bond yields have peaked, right?
Okay,
That
yeah,
this 5% area on the 10-year is probably going to be the area where we peak. I think we're probably going to be more range bound in the 10-year and the 30-year than we're likely to see a big decline in it. Meaning, like, I
okay,
think we're going to stay somewhere between, let's say, 430, which is 4.25, which is the October 22 high, and we're likely to stay between 4.25 and 5%, right? And so if you look, October 22 was around 430, I think. And if you notice, we're
yeah,
making some sort of reversal candle today, at least if these
yeah.
numbers, hold up. Certainly treasury auctions have been pretty horrible, right? And so that issuance is going to keep some of I think
There
a
have been some
softness.
good auctions. I think Santelli gave some of these auctions Bs and As on bid to cover recently.
Right. Yeah, there have been some decent ones, but the 7-year yesterday wasn't so great. The 30-year 2 weeks ago wasn't great at all. Right. So I think there's been a mixed bag in terms of the 10-year tip auction last week, I thought was pretty bad as well. When you look at indirect demand coming down, when you look at the tails on the auctions have been pretty wide. When you look at primary dealers getting stuffed with a lot of these treasury issuances, they just don't seem to be. There seems to be so much of issuance coming that I think it's going to keep the bond market a little bit soft on the back of the curve. Additionally, you're not seeing enough economic data to really suggest that you're going to go into a recession at this point, I think, really to push the back of the curve down. But what is clear to me, which I think is really the most important part, is that the front of the curve is starting to come down, right? And I think that's really the part of the curve now that's going to drive a lot of parts of the market. And essentially, what I think we're going to start seeing is, the yield curve has been inverted for a very long period of time. And I can share with you my chart.
Okay, let me stop sharing and you could share.
Oh, I
So
can't. Oh,
at the
I can do
bottom.
it. Yeah. Um, so basically what I've been watching now is that the S&P 500, which is in yellow, it's inverted, right, has
Yeah.
basically been trading with the curve. So when the yield curve goes up, the S&P 500 goes down. And you can see that that was pretty much the case, and it's still been the case up until yesterday. You can see there was a pretty big move higher in the yield curve the last 2 days now, but the S&P hasn't yet responded. My expectation is that you will see, if the curve continues to steepen, you're going to see the S&P 500 move in the direction of the yield curve, which will be.
So I think a lot of people don't know it. So let's clarify it. So while the yield curve was inverting and people were talking recession, the
Right.
market thrived. Okay.
Correct.
And now that we have a steepening or an unwinding of that, the markets are going to suffer as
Correct.
you have a steepening of the curve. It may be good for banks, but it's not good for the economy.
Right. I mean, essentially what I think, the way I think the mentality of the market worked from, call it, the middle of last year and then even through SVB, was that an inverted yield curve meant that recession wasn't coming yet, right? So a lot of times people think that inverted yield curve means recession, right? It means recession, but it usually means recession 18 to 24 months later.
Yeah.
It's when the yield curve starts to re-steepen that you really have to start worrying as an investor, because that's really, and it's the manner in which the yield curve steepens that really matters, right? So the first half of the re-steepening was in the form of the 10 moving to the 2. I think the next part is going to be about the 2 moving to the 10. So the 2 moving down. And that's going to be the signal that we are heading towards some sort of economic slowdown, some sort of economic potential recession, I think sometime in the first half of 2024. And I know that the consensus was last year that we were going to have a recession last year. It never happened. Last year, my view was that we weren't going to have a recession, and instead we were going to be in this sort of stagflationary environment where we had this slowing growth rate and higher and a rising unemployment rate, which we have the unemployment rate that's rising. And certainly in the first half of last year, we saw some stagnation, but then the third quarter reaccelerated.
It seems like the market has completely embraced the soft landing. And I heard a comment from David Rosenberg, who said that's just part of the cycle. The soft landing is a transition from growth to slower growth, and you always have a soft landing prior to the contraction.
That's correct.
Okay,
I mean,
right.
That's absolutely right. I mean, you're going to have a soft landing before you have the hard landing. And
Right.
look, I'm not advocating here for like a 2008 type of recession. I mean, this could be a 2000 type of recession where it's, soft and we see earnings contraction, and it's enough to reset valuations and multiples on stocks. But I think what's important here is that if the yield curve is re-steepening in the form of the 2 moving down to the 10. I mean, the yield curve has been inverted for a very long period of time.
Couple years?
It's been inverted. I mean, if we go back and look, it first inverted really July of 22. I mean, it touched it in April, but then it snapped back. I mean, so we've been inverted now for almost 18 months, right?
Okay. Yeah.
Which is a fairly long period of time. I mean, if you go back and look at some of these other periods, you can see this was 546 days. This was 336 days. This was 595. I mean, if we just look at from when it was inverted, back in July, we're right now at 504 days. So we're in this
in the zone
ballpark where it's time for the yield curve really to think about steepening again, right? And seeing that part of the movement from the 2 to the 10, because look, as inflation slows, the Fed is going to have to cut rates. It's not about what the nominal Fed funds rate is, it's about what the nominal real Fed funds rate is, right? And if inflation keeps coming down to the 3% number or 2.5% number, and the Fed funds rate is at 5.5%, and you're at 3% on inflation, that's a 3.5% real Fed funds rate, which is extremely tight, right? So in order to keep that Fed funds rate in that 2.5% range, the Fed's going to have to cut rates to keep that real rate from being too restrictive. Otherwise, actually, as inflation comes down, if the Fed doesn't cut, policy will become more restrictive, which is the piece that people really, I think, miss, is that as inflation is falling, policy is actually becoming more restrictive by the day because the real rate is rising, which is why we have real yields across the curve over 2%. And
Okay.
so the Fed is going to naturally have to cut. The question is, how much does the Fed have to cut? And if we see the 2-year rate, which basically trades with Fed fund future contracts, from a technical standpoint, the 2-year looks like it's breaking down, right? It's broken I think some key support levels here at 4 3/4, which I think sets up a move potentially to 450, right? But I think what's really important here is that when we look at the Fed fund future for December of 25, which is about a year from now, the 2-year rate is essentially trading with this contract at this point because it's only about a year away. And you can see that as the market prices in rate cuts, the 2-year is trading along with it. And so I would think that as long as the market continues to anticipate lower Fed funds rates, you're going to see the 2-year continue to decline. And this spread over time should begin to contract a little bit. Because if we look at 2024, you can see that it was the same exact case. And 2024 is only 1 year away now.
Okay,
so I think that we're going to
go ahead.
So I think we're going to see the yield curve continue to re-steepen in the form of the two falling to the back of the curve. And essentially, I think this is what's going to be, sort of a major problem going forward. Because I have another chart here I can show you, which I created, which I call the 210 curve 18-month forward. And I'm basically taking a 2-year forward rate and a 10-year forward rate, and I'm creating a 10-2 curve out of it. And what my analysis shows, it doesn't go back, I don't think, far enough to really make it statistically significant, only because we've only had 2 recessions during this period of time, or 3 if you count the 2020 COVID one. But what you see here is that it's when this curve becomes positive and then really starts to steepen, that's when you have, the equity markets really start giving back. So in this case, the curve was negative 50 basis points in 2000. It rose about 50 basis points. That was when we really started seeing, the equity market selling off as the recession really became the case. In this case, we never got to zero. It never got below, but we went from about 10 basis points to 50 basis points, which was a rise of about 40 basis points. And that marked the top again, but it was about the curve continuing to rise. Now, at this point, we've had, some back and forth here with the curve. But you can see that at least since this point here in July, we've gone up about 50 basis points from bottom to top, and about 30 basis points from this point to this point. So my feeling is if the curve continues to rise from here, that you're going to see the S&P 500 turn lower and trade down as the market begins to worry about a hard landing.
Okay. I noticed it seems like you're still constructive the dollar, Michael. I turned negative after that CPI took out 105. I like the whole world changed a week ago, and I'm just hoping for a little pop in the dollar to buy Aussie dollars and buy euros. You're still constructive the dollar here?
I'm not. The dollar is sort of difficult for me right now because when I look at the euro, it's kind of hovering around this 61.8% retrace level. When I look at the pound, it's still in this area where it's about 50-ish% or so. Maybe a little more, 61.8 it hit actually today. I
So
really
I'd
do.
buy a pullback in cable, I'd buy a pullback in euro, some type of retrace of their rally, like euro 104.5 to
See, the problem
110.
I have though is that when you look at this pattern, right? It first of all, this was a new low versus this. And this looks like a very, sort of impulsive rally down, which tells me this is
Yeah.
probably your 5-wave structure.
Yeah.
This is probably your 3-wave retracement.
Okay.
So this could very well be a 1 and a 2,
Okay.
right? Which means that you get another leg down. And I think the problem here is
Would
that,
that be normal reaction of the dollar with your interest rate narrative that
well,
the
that's the
dollar
thing,
would?
right? If we go into a recession, you get a flight to safety. If the US is going into a recession, chances are Eurozone is going into a recession, if not already in one. And you probably think that the UK will be in recession too, which means that the dollar should actually still outperform the euro and the pound. The one that I'm not bullish on though is the yen. Like I
Oh,
think the
right.
yen I think the yen is going to strengthen versus the dollar from here.
Yeah.
I mean, you have a nice potential double top pattern.
Yeah. Yeah.
We know the BOJ is going to have to do something in terms of raising rates there. So I think that the odds favor the dollar continuing to be strong against the euro and the pound, but I think it's going to also be fairly weak against the yen. I think your idea about the Aussie dollar may have some legs, and the only reason I'm suggesting that is it looks like you have a nice sort of bottom
Yeah.
process here, but more importantly is look at a couple of the key gauges that go into China, the Baltic Dry Index, which measures freight rates and things of that
Yeah.
nature. I mean,
Turning.
it's turning pretty materially, right?
Copper is too, right?
Yeah, when you look at iron ore prices, they've started to
Yeah.
rise, although they're a little bit weak. We have to wait for a breakout here. And then you can see gold, copper is breaking out, I
Yeah.
think, as well. And, if you get a breakout in copper, you get iron ore prices moving up. I think that's a positive sign because I think that's more China related. That's obviously going to be positive for Australia and any sort of exporting commodity based economy, which could mean that the dollar weakens against some of these commodity exporters like Australia, like Canada, like I don't know, some of these other emerging markets like maybe Brazil.
Okay. Um, so looking at, so we've covered the dollar. Really the star of the show has been gold and silver. And I tell people, now I wouldn't chase it. Um, but it does look like we're set up to take out that triple top. It almost looks like a layup. Do you think that we'll have some type of pullback first, or are you
Yeah,
bullish,
I
bearish
was
gold?
actually I was actually doing a Zoom session yesterday for someone else, and someone asked about gold, and I said to them yesterday, it looks like gold to me for right now has put in some sort of short-term top. So when I look at things to be overbought or oversold, I have a criteria where I look for the stock commodity index to be trading over the upper Bollinger Band and for the RSI to be over 70. And right now you have both of those conditions. And so what that tells me is that right now this is a point where you're likely to see either gold pull back maybe back to this 20-day moving average, or you're likely to see it just consolidate and trade sideways. I think if it consolidates and trades sideways, it's a very bullish indication that gold is going to probably break out and move higher. I don't really know what that means for inflation because obviously, if you're seeing things like gold and copper and silver moving up, that could be an indication that inflation is not really completely going to go away. Um, and in fact, I've been mulling and thinking about just buying the GLD for my portfolio because it seems to me in this environment, in this world, something has changed with the structure of the economy here in the US and abroad. And I think it's mostly due to I mean, I can show you, I don't think enough people focus on this, but US employment rate, labor force. Let me just see if I can find the chart, and then
So
I'll
really, Michael, when you really look at the broad picture, everything rallied. It's all if the dollar is bad, everything goes up. At
that's
least,
financial conditions.
okay. So I'm looking for a bounce in the dollar, to sell into, right? If
Right.
I want to try and buy euro at 107 and a half, 107, maybe I'm dreaming. But if that happens, you would think that we'd get an S&P correction, at least to correct the advance from 41 to call it 46. Couldn't we
Yeah.
get just a pullback like to 4,300, 4,350 in S&Ps?
Oh, I think that's certainly possible. I'm actually looking for the whole thing to
The whole
disappear.
thing? Okay.
Yeah.
Well,
You
if
can
we
see the
take out
dollar. I mean,
41, we take out 4,100, it's game over.
yeah, my numbers around 40.50 is the level that needs to really hold. That was the
Okay.
level that I had noted in October that the S&P when it got to around 4100 was oversold, and as long as we held 40.50 to 4100 we were going to be okay. But if we broke that 40.50 4100 level, I thought there's problems. But you can
Okay.
see here that the dollar right now 61.8% retrace, and
Right. We
it's
talked about
bouncing at
that
this
today.
point, right? So
Yeah.
if you start seeing the dollar, moving up along with a yield curve steepening, I think that's going to really send a message of a little bit of a flight to safety sort of growth scare warning. But what I wanted to show you was this chart. This is a chart of the people not in the U.S. labor force, right? Do you notice anything here?
You mean the spike and then just sideways?
Yeah.
Yeah, I
I,
noticed that.
I mean, what this shows you is that basically 5 million people left the labor force after COVID and never came back.
Never came back.
They haven't come back. I mean,
Yeah.
what this is sort of telling me is that there were people who were on the border of retiring, and they
Yeah.
decided to retire and not come back. And this has created a labor shortage. And this
Right.
is why you've seen wages increase. This is why, you've
Unions
seen,
are getting their deals.
right.
Yeah.
And so if you have a shortage of 5 million workers in the economy, and by the way, it's probably not coincidence, right, that the jolts went up. If you look at the jolts data, the jolts was around, 8.3 million going into COVID, and then it peaked at, about 11 million, right? And no, I'm sorry, I'm looking at the wrong scale. It was at 7.1 million, and then it peaked at 12 million, an increase of 5 million, right? So the 5 million that left led to a 5 million increase in job openings, right?
Yeah.
I
Right.
don't think that's a chance. I don't think that's by chance, right? And so what this is telling you is that there's a hole in the economy of 5 million workers. And as long as that hole exists and there's that imbalance, then you're going to have this sort of wage pressure that's going to remain, and that it's not going to go away because there's just not enough workers to fill all the open jobs. And that's going to sort of keep this inflation in this 3-ish to 4% region, because that's where your average hourly earnings have essentially been now since we've kind of come down. Was there, I guess, a big revision? I guess, did I miss that?
So is this going to be, it sounds like a replay of the 70s where the Fed had to go at it, I believe, three different times of tightening regimes, and that
Right,
we've seen the first, and now there's a pause because, Powell's taking victory laps at his last
right.
presser, and that they're going to have to come back and do it again.
And again, if financial conditions ease too much, that's exactly what's going to have to happen. And I mean, when you look at the S&P 500 in the 1970s, I mean, I was not born in the night. I was born in the late 70s, but I don't know. I mean, you had a series of basically just rolling, bear markets and bull
Yeah,
markets, right? I mean, you
yeah.
remember, you're a little older than me, I guess, but
Yeah,
I mean,
until 82, and August of 82 was the beginning of the prolific bull market.
Right. And
1982.
essentially, I think what we're setting up for is something similar to this, right? Where we're going to be in a market that is going to go nowhere, right? That maybe we're in this 3,500 to 4,700 range for the next few years. That's
Yeah.
what I think we're in.
Okay.
The same exact thing happened in 2000, right? And if you look at the market over a period of time, right? If you go back to the 1910s, right? I don't know how far back this chart's going to go, but if you go back to 1910, I mean, you have this sort of period in time where you have these, we had the big 20s, then we had the big correction, recession, depression. Then we had a period where we did nothing. Then we rallied. Then we did
Right.
nothing. Then we rallied. Then we did nothing. Then we rallied. And now we're due to probably do nothing again, right? Where you have these periods, you go back, this is 1962 to 1982, 20 years.
Yeah. Yeah.
You have basically the year 2000 to the year 2013, call it 13 years. Now you've had 2013 to 2022. Maybe you go through another period of 5 to 10 years of nothingness.
Okay.
Why would
So
that be so hard to imagine?
yeah. So it's going to be important to know how to be tactical.
That's what I think. And I think that what I've been thinking about is not only, this is a type of market I feel where you have to be aware of a lot of different things going on, but I think fundamentals really matter, because this is a type of market where if you understand the underlying fundamentals, you'll know when the valuations have gotten to be too low, and you'll know that when the valuations have gotten to be too high, because essentially what this market is the way I'm thinking about it is that I want to be a buyer of the market and individual stocks and individual names when the index is coming down, and I want to be a seller of it on strength, which is essentially what I've been doing now for the last 18 months, right? So like right now, for example, I'm not doing anything because this market's at the upper end of the range, and I kind of raised the amount of cash that I want to hold. But I mean, if we look at this, right, we're right back around the upper end of the range
Yeah.
here. 21 was where we peaked the last time. And if I
Yeah.
look at it from another perspective, if I look at it from I think if I did a blended PE 12 months forward, again, you can see that, we're at the upper end of the range in terms of valuations. You have to forget about
Yeah.
this. This was an anomaly, I think, right?
Yeah.
And you can see we're back up to this 18 area. 20 was the July high, which seemed too high. And if you're in an environment where inflation's likely to stay high, the corporates are likely to be in a position where they're going to see wage and labor problems. It probably also means that S&P 500 earnings growth for next year is too high, that margins are going to have to compress more, that you're not going to get 10% earnings growth next year, and that you're likely to see valuations and multiples contract. So I think all of this stuff just goes hand in hand. And
Okay.
and going back to the shorter term, because I guess your audience is probably more. So the reason why this whole rally happened was because you had two things happen. The market got very short gamma in the October lows, and then the S&P gamma positions were very net negative, which created this sort of violent face ripping rally off the low.
Yeah.
Then that triggered, the systematic funds to go from being short the S&P
Yeah.
500 to having to go long the S&P 500, which created the second wave up. And now we're sort of at the end of it. I no idea why the S&P would be up this morning. And with the yield curve sort of steepening today, I would be very wary of this move that we're seeing in the pre-market. Because again, what we've typically seen is that, the
I'm
S&P
with you on that, Michael.
the
Yeah.
S&P 500 tends to trade with the direction of rates, and more importantly, the direction of, the yield curve. And so, I
Well,
will have to
time
say,
time will tell, and I don't think it's going to be that long. For
right.
either we're going to blow through 4,600 or we're going to get that pullback. And Michael, I'm getting a comment from Ingmar. Thank you, Michael. Great interview. What's the best way for people, since you're having trouble on Twitter, let's get people just to subscribe. So what's the best way to follow your work, Michael?
Oh, so you can just go to my web. So I have Twitter, obviously, but I also have my website, Mock Capital Management, which I'm taking you to I just call it the Market Chronicles. So you can get all my stuff here. I put out a daily commentary for free. And then from there, you can get access to like a lot of my subscription service. I list articles that I'm writing for there. And I also have a Substack as well, where I also publish this as well. And I have a following on Seeking Alpha too. I write here as well, and I have a subscription service. So all of my content is pretty much divided up into Substack, Seeking Alpha, or my own website. So that's pretty much where you can find me.
Okay, Michael, and you do great work. Keep it up, keep your chin off, and shake the dust off your sandals when people are giving you a hard time, buddy. And
Yeah,
I guess we have to have thick skin to do what we do and, take risk, all of it. Appreciate you being with us and sharing your work, Michael.
I
I'm
appreciate you taking the time to come on.
Yeah, I'm a fan and I'm rooting for you, and
Thank you.
look forward to talking to you this winter when the snow is falling somewhere. All right.
I'll have to change my background.
All right, Michael Kramer, everybody, check him out at and it is the Market Chronicles. Don't get it confused with the Martian Chronicles, right? Okay, so Michael's read that too. Everyone have a great day. You could join the team in 6 minutes on the Morning Edge. Don't forget, don't just count your pips, count your blessings. A lot of people can't afford to take risks. They're deciding whether they should buy food or pay their rent. So consider yourself in great, really, you're blessed to have money to lose.
That's right.
I'll see everyone tomorrow. Good hunting, and thanks again, Michael. See you,
Thank you,
brother.
Dale. See you soon.
All right.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.